In today's world, simply earning a good income is not enough to secure a comfortable future. Saving money is important, but it's not the only answer. To truly grow your wealth and achieve your financial goals, you need to make your money work for you through investments. Investing allows you to put your money into assets that have the potential to increase in value over time. Whether it's stocks, bonds, mutual funds, or real estate, investing provides an opportunity to outpace inflation and grow your savings at a rate that traditional savings accounts cannot match. By investing wisely, you're not just saving for the future, you're creating a solid foundation for financial freedom. Compound growth is the magic behind successful investing. It's the snowball effect of earning returns on your initial investment, as well as on any returns you've already earned. When you reinvest your earnings, they, in turn, generate their own returns, creating a powerful cycle of growth. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, becoming larger and larger. The longer you let your investments compound, the more significant the results become. Even small contributions made consistently over time can grow into a substantial nest egg. The earlier you begin, the more time your investments have to work their magic and generate significant returns. Every pound you invest is a step towards securing your financial future. The stock market can seem like a complex and intimidating world, but at its core, it's simply a marketplace where buyers and sellers come together to trade ownership in publicly traded companies. These companies, ranging from tech giants to retail chains, offer pieces of their ownership in the form of stocks or shares. When you buy a share of a company's stock, you're essentially becoming a part owner of that company, albeit a very small one. The price of a stock is determined by supply and demand. This constant fluctuation in prices is what creates opportunities for investors to buy low and sell high, potentially generating profits. By understanding the basic principles of how the stock market works, you can approach investing with more confidence and make informed decisions that align with your financial goals. A share of stock represents a unit of ownership in a company. When you buy shares of a company, you're essentially betting on its future success. If the company performs well, its stock price is likely to rise, increasing the value of your investment. There are two main ways to profit from stocks: dividends and capital appreciation. Dividends are payments made by companies to their shareholders, typically from their profits. Capital appreciation refers to the increase in the value of your stock over time. Before investing in any stock, it's essential to conduct thorough research and due diligence. This involves understanding the company's business model, financial performance, industry trends, and competitive landscape. Start by reviewing the company's annual report, which provides a comprehensive overview of its financial health and future prospects. Pay attention to key financial ratios, such as price-to-earnings ratio and return on equity, which can give you insights into the company's valuation and profitability. Remember, knowledge is power, and the more informed you are, the better equipped you'll be to make sound investment choices. Mutual funds offer a convenient and diversified way to invest in the stock market without having to pick individual stocks yourself. Imagine a basket containing a variety of fruits. That's essentially what a mutual fund is, but instead of fruits, it holds a portfolio of stocks, bonds, or other assets. When you invest in a mutual fund, you're pooling your money with other investors, and a professional fund manager uses that money to buy and sell securities on your behalf. This pooling of resources offers several advantages. Firstly, it allows you to achieve diversification even with a small amount of money. Secondly, mutual funds are managed by experienced professionals who have the expertise and resources to research and select investments. Mutual funds offer a hands-off approach to investing, making them suitable for both beginners and experienced investors who prefer not to actively manage their portfolios. Mutual funds come in various flavors, each catering to different investment objectives and risk appetites. Equity funds primarily invest in stocks, aiming for capital appreciation over the long term. Bond funds invest in bonds, providing regular income in the form of interest payments. Balanced funds offer a mix of stocks and bonds, providing a balanced approach to investing. Index funds passively track a specific market index, such as the FTSE 100 or the S&P 500. Other specialized mutual funds focus on specific sectors or themes, such as technology, healthcare, or emerging markets. These funds allow investors to tailor their portfolios to their specific interests or investment outlook. With so many different types of mutual funds available, it's essential to carefully consider your investment goals, risk tolerance, and time horizon before making a decision. Selecting the right mutual fund requires careful consideration of several factors. Firstly, determine your investment goals. Are you aiming for long-term growth, income generation, or a combination of both? Secondly, assess your risk tolerance. How comfortable are you with the possibility of your investments fluctuating in value? Next, consider the fund's expense ratio, which represents the annual fees charged by the fund manager. By carefully considering these factors and conducting thorough research, you can choose a mutual fund that aligns with your investment goals and sets you on the path to financial success. Retirement might seem like a distant event, especially when you're in the prime of your life focused on immediate financial goals. However, time has a way of sneaking up on us, and the sooner you prioritize retirement savings, the more financially secure your golden years will be. Retirement planning is not just about accumulating enough money to cover your expenses. It's about maintaining your lifestyle, pursuing your passions, and enjoying the freedom that comes with financial independence in your later years. The earlier you start saving, the more time your money has to grow through the power of compound interest. By making retirement planning a priority today, you're investing in a brighter and more fulfilling future for yourself. Building a solid retirement plan requires a strategic approach that considers your current financial situation, future goals, and risk tolerance. A good starting point is to estimate your retirement expenses. Consider your desired lifestyle, healthcare costs, potential travel plans, and any other anticipated expenses. Once you have a clear picture of your future financial needs, you can determine how much you need to save to maintain your standard of living. Next, explore different retirement savings options. Employer-sponsored retirement plans, such as workplace pensions, offer a convenient way to save directly from your salary, often with employer contributions. Individual retirement accounts, or ISAs, provide tax advantages and allow you to contribute a certain amount each year. Regularly review and rebalance your portfolio to ensure it remains aligned with your risk tolerance and time horizon. Navigating the world of retirement accounts can seem daunting, but understanding the different options available can help you make informed decisions that align with your financial goals. Workplace pensions, often offered as part of employee benefits packages, provide a structured way to save for retirement through payroll deductions. Individual retirement accounts, or ISAs, offer tax advantages, allowing your investments to grow tax-deferred or tax-free, depending on the specific type of ISA. Self-invested personal pensions, or SIPs, provide more investment flexibility, giving you greater control over your retirement portfolio. Each retirement account type comes with its own set of rules, contribution limits, and withdrawal penalties. Consulting with a financial advisor can provide valuable insights and guidance in choosing the most suitable retirement account for your needs. Effective retirement planning is an ongoing process that requires discipline, commitment, and a long-term perspective. Here are some valuable tips to help you secure your financial future. First, start early. The power of compound interest is amplified over time, so the earlier you begin saving, the greater your potential returns. Second, save consistently. Even small contributions made regularly can accumulate significantly over time. Third, diversify your investments. Spread your investments across different asset classes to mitigate risk and enhance potential returns. By taking a proactive approach, seeking professional guidance when needed, and staying committed to your long-term goals, you can pave the way for a comfortable and enjoyable retirement. The power of diversification, spreading your risk. In the world of investing, diversification is often hailed as the closest thing to a free lunch. It's a strategy that involves spreading your investments across different asset classes, sectors, and geographies to reduce the impact of any single investment on your overall portfolio. Think of it like a balanced diet. Just as you wouldn't rely on a single food group for all your nutritional needs, you shouldn't rely on a single investment or asset class for your financial well-being. Diversification helps mitigate risk by ensuring that if one investment performs poorly, others may perform well, cushioning the blow to your portfolio. For instance, if you had invested all your money in technology stocks during the dot-com bubble of the late 1990s, you would have experienced significant losses when the bubble burst. However, if you had diversified your portfolio by including bonds, real estate, or other asset classes, your losses would have been mitigated. Diversification is not just about spreading your bets. It's about strategically allocating your investments based on your risk tolerance, time horizon, and financial goals. A younger investor with a longer time horizon might choose a more aggressive asset allocation, with a higher proportion of stocks, while an older investor approaching retirement might opt for a more conservative approach, with a larger allocation to bonds or other fixed-income securities. Remember, diversification is not a guarantee against losses, but it's a powerful tool that can help you manage risk and enhance your chances of achieving your long-term investment goals. Mastering risk management, protecting your investments. Investing involves risk. Stock prices can fluctuate, interest rates can change, and economic conditions can shift unexpectedly. Mastering risk management is about understanding, assessing, and mitigating risk to protect your investments. Key aspects include knowing your risk tolerance and setting realistic investment goals. Regularly review and adjust your strategy as market conditions and your goals change. Risk management is an ongoing process, essential for protecting your investments. By understanding your risk tolerance and staying informed, you can navigate the investment landscape with confidence. Investing wisely, your path to financial freedom. In today's complex financial landscape, mastering the art of investing is no longer a luxury reserved for the wealthy. It's a necessity for anyone seeking to achieve financial security and build a brighter future. From the volatility of the stock market to the relative stability of mutual funds and the long-term planning required for retirement, navigating the world of investments can seem daunting at first. However, armed with knowledge, a clear understanding of your financial goals, and a disciplined approach, you can harness the power of investing to grow your wealth and secure your financial well-being. Remember, investing is not about get-rich-quick schemes or trying to time the market. It's about making informed decisions, managing risk effectively, and staying committed to your long-term financial objectives. Whether you're just starting out or are looking to refine your investment strategy, the principles outlined in this essay provide a solid foundation for making sound investment choices. Embrace the power of compound growth, diversify your investments wisely, and never underestimate the importance of seeking professional guidance when needed. Investing is a journey, not a destination. It requires patience, discipline, and a willingness to adapt to changing market conditions. But the rewards are well worth the effort. By embracing the principles of informed investing, you can pave the way for a more secure and prosperous future for yourself and your loved ones, turning your financial dreams into a tangible reality.